than your currency. Splurging millions, buying houses like Monopoly. Fucking 9 to 5, man, the money is
Hey guys and girls, welcome to this week's episode of the No BS with Birchy podcast. I'm your host Nathan Birch, and this is a show unraveling the truth to the facade of the 21st century. We're now exiting the matrix and waking up to motherfucking reality. Thanks a lot for tuning in again, guys. Today I'm going to be talking about buying properties interstate and how to, protect yourself. Should you be doing it? How to minimise risk, etc., etc. So, firstly, should you, as an investor, should you be buying properties just in your own backyard? What is the benefits of doing so, and what is the benefits of buying properties out of state or out of your backyard? And looking at some of the pros and cons of each. So, I guess a lot of people, when they start out investing, they do what they feel comfortable with. They will just go back to their own area. So for me, when I first started, people actually very commonly misconstrued the fact that I bought properties in Western Sydney, and they think I grew up in Mount Druitt. Mount Druitt, for those of you that don't know, Mount Druitt is a blue collar working class family area of Sydney. It did have a stigma about it back in the 90s of being rough and people get rolled and jumped out there. For me, as an investor, I looked at what I could buy and what I could get access to, and I was trying to look at value of what things would cost. So when I grew up, I was looking at the Hills district of Sydney, and when I first started investing, like a 3-bedroom red brick house was about $450,000, but there was an interest rate of about 8% attached to that. So if I bought a property at $450,000, owed say $400,000 on it, had an 8% interest rate, that would have been like $35,000 a year or whatnot to hold on to that property. I was only on $50,000 a year, so it was very hard to get into that property. A lot of people nowadays think, Birch, you must have been so lucky to buy a property back then. It was so cheap back then. You would have been so easy to buy a property. It's so tough now. You've got no idea how tough it is. I know how tough it is. I was in those markets beforehand, and I had my own challenges to deal with, just as your parents or whoever else was buying at that period of time as well. So looking at, I couldn't see it affordable to buy in the area directly where I was living, so I had to look further afield, and I wanted to stay within Sydney. So I started looking around, and I found the cheapest areas of Sydney, which were out in these areas like Mount Druitt and whatnot, and you're looking at properties for like $150,000, $200,000 a piece, and they'd rent for, $200, $250 a week. So I saw value there that I could get into something that was cheaper. It wasn't what I wanted, but it was just that I could afford it, I could get my hands into the market, and those things have gone up, tremendously over the years, but it was the best thing I could get my hands onto. And I went and bought lots of properties in the Sydney market until I couldn't buy any more. And I got to about, 7 or 8 properties before I started looking further afield. And I remember I had a girlfriend back in 2003. I think I was like 18, and we went to go to like the Queensland, to like the Gold Coast, and check out all the movie world and all that sort of stuff. And there was no internet back then. There was no realestate.com. There was no podcast. There was no YouTube. There was nothing like this. And I was like, where do I start? There was no, and so I went and I found the cheapest, crappiest areas of Brisbane. And I remember looking at properties there for $50,000 renting for $100 a week and stuff like that. And I had a lot of fears. I thought, if I buy a property in a state, Queensland, there used to be a lot of scammers out there that would take people on holidays to Queensland and say, buy this development. It's a brand new house. You can negative gear it, tax deductions, whatever. And these properties that people would buy, they would go down in value because they were never worth what they paid. So they'd go and pay, that you'd fly up, you'd meet the slimy salesperson in his suit, a tie, put you in the BMW, you'd feel like a rock star for the day. They'd try and sell you 2 or 3 or 4 properties. They'd take you on this little tour, and then you'd be stuck with these properties that are like, you've paid $100,000 extra for. There's still those people out there today that are trying to sell you stuff, jewel keys and that sort of stuff, but it's a different sort of market. But my fear at the time was I saw people that had been burnt from buying there. I was like, if I buy in Queensland, it might be a dud. A townhouse, they never go up in value. If I buy a property in Queensland, if I need to go and fix a tap washer, I can't go and attend to any repairs that are there. So there was a lot of fear at that point in time. And, I see people when I speak to them on a day-to-day basis, most people are now, open to the fact that like, well, I can't afford to buy in Sydney or Melbourne or Brisbane or whatever, so they might need to go to a different sort of location. But there's still people that have fear. They go, I must go to the property and see it and touch it and feel it and be able to work on the property if there's an issue, renovate the property, etc. So you need to weigh up, what are the pros of buying local? What are the pros of buying and the cons of buying local? What are the pros of buying a farm? And ultimately, I guess after 20 years of investing in the property, the way that I see it is that there's a lot of variables, but the most important one is knowing what is your strategy and having clarity as to where it is that you're at today, where is it that you're going to, and what vehicles are they that need to get you to where you want to be. And I see where the biggest issues are is where people have the issues in their head and their mental challenges of being able to overcome sort of where they're fearful over, I can't do a renovation and I can't do this. But if you have clarity, you have a good strategy, you know what you need to achieve. People come to me and they're like, Nathan, I don't want to buy this, or I want to buy this, or I want to buy that. The biggest realization point came to when I bought about 7 properties in my portfolio, and then I couldn't buy properties anymore because I couldn't get loans. And then that was a big issue because if I didn't have money, I couldn't do a deal. And it was at that point that I really reflected in, and I was like, hang on a second, it's not about what I want as an investor or what I want as a person or what my emotion tells me that I want. It's about what I need. What I need is to have, is what the bank needs. So I need money, and I need the bank to lend me money. So suddenly I can then go backwards and go, okay, well, for me to get money from the bank, what is it that the bank wants from me in order to give me that money? And for me, it was a balance of cash flow and equity and growth. And that's why I talk about those 3 things: buying at below market value, so you can get the equity out, having upside for capital growth, which is what I want, and having the cash flow, which is what the bank wants to lend me more money. So it's nice to go and buy properties all around your house, but that's justifying and satisfying your emotions, your ego, your fears, your emotions. Any of those emotional things are all screwed. Don't buy properties for emotion, you buy them because the numbers have to stack up. If the numbers stack up in your own backyard, do it. But if they don't stack up, then research other people's backyards. People go, oh, well, who'd want to buy them? I remember people used to laugh at us 5 years ago. People used to say, Birchy, why do you buy properties in the Gold Coast for? They're never going to go up in value. Why are you buying it? I'm like, the value of what we're getting for our investment is way below market value. When we start seeing the market take off, that will be the first cab off the rank. And what have we seen? Everything in southeast Queensland is now double in a period of 12 months. The cash flow was positive, the growth was strong, and it was just very good value. So as an investor, I want to be buying properties of intrinsic value. Am I telling people to go and buy in the Gold Coast today? I buy, from what I used to buy 50 properties a month in the Gold Coast, I'm buying probably 5 or 3 or 8 in the Gold Coast at the moment. I'm looking at different markets because that market is too overheated. So one of the biggest things as a contrarian investor is, I'm looking into markets which are, soft, which have been battered, that have been bruised. I don't want to be buying into heated markets. I don't want to be buying into, very hot climates, because then I don't have control as an investor to dictate my terms, my price, and be able to make value out of the property. So you will never see me lining up at a line to try and get something or do something, because I just don't see value in that. I'd rather go where people don't see the value, because that's where the opportunity rises. So, do look outside your local backyard. You want to be focusing on what the property. If you, I always ask people this question. I don't put this in the podcast. I don't put it onto YouTube. I've only ever put it into webinars beforehand. But I always ask the question of, how would someone get to Perth? And people always say, you'd fly to Perth, right? I ask people that live in Perth, how would someone get to Perth? They'd say, you'd fly here. The answer that I'm looking for is, you need to work out where Perth is. Because if you live in Perth, you don't need an aeroplane to get to Perth. You're already there. If you're in Sydney, you might need a plane to get to Perth. But you can also drive, you can walk, you can ride your scooter, you can hop on a camel, ride a horse, helicopter, push bike, roller skate. There's many different ways on how to get there. If you're in New Zealand, for example, and you want to get to Perth, you can't ride your bike, walk, hitchhike, whatever the case may be, because you've got to get across the water. So where you're starting from and where it is that you're going to, those destinations are the variables in your portfolio. So do you need cash flow? Do you need equity? What is your position looking like? What steps do you need to take and what vehicles do you need in order to get to where you want to be? Me being in Sydney, if I want to get to Perth, wouldn't just take a plane to get to Perth. I would need to walk to the train station. I would need to hop in the train, get off at another train station, get into a bus, hop into the airport. I need to drive my car, park at the airport. There's different modes of vehicles in order to get there, but so many people don't plan on their journey. They just go, well, I need a plane or whatever. You need to break it back down to smaller components and work out what is the vehicle that I need to get to the end goal. And when you get off at Perth, is that going to be your destination, or do you need to catch, say if the plane lands at whatever airport it is, you need to then make your way from the Perth or the Western Australian airport down to Perth CBD. So you would need different vehicles on the other side. So at what stage of your portfolio are you at today? What sort of moves do you need to make in order to get to where you want to be? They're the most important questions to be asking. Then you can work out what sort of properties do you need as a vehicle. So for me, at the time, I was like, I need to buy properties. If I'm going to be pulling equity out of properties, if I'm putting 50 grand in and I'm only getting, if I'm buying a 500 grand property and I'm getting 50 grand equity out of it, 50 grand equity on 500 grand is good, it's 10%, but it's not 20% for my deposit and closing costs back. If I was buying a 200 grand property that rents for $300 a week, then I know that property is going to be, looking after itself from a cash flow perspective. It's going to keep the banks happy from, covering the mortgage and all that sort of stuff. But if I'm getting 50 grand equity out of a 200 grand property, I'm going to need my 20% deposit back, and I can use that to go and buy the next property. So as an investor, if you've got clarity as to what sort of parameters you need in your portfolio, then you can work backwards and go, okay, how are those assets going to get me to where I want to be? And obviously, as always, none of this is financial advice. I'm not your financial advisor, but you need to work out for yourself how to sort of get yourself to that end goal. So, I've got a few little notes here that I'm looking at on my screen. I've gone off on a tangent without looking at any of my notes that I made beforehand. But you need to make sure that you've got the right people around you. You need to make sure that you've got the confidence when doing those deals to go, okay, I can buy this thing without physically seeing it. And a lot of people get fearful and they go, well, I don't want to be buying a property in a state that's not mine. So, for example, Sydney buying in Perth, or if you're in Melbourne buying in Brisbane, or if you're in Brisbane buying in Sydney, people get fearful of being able to do that. And I always think back to if I was to buy shares, and I'm not a share investor, I don't encourage people to buy shares, but good luck if you do. But if you were to go out and buy Woolworths shares, if you're going to buy Coles shares, if you're going to go buy McDonald's shares, right, whatever company you're going to go buy shares in, if you were to go buy shares, would you go to each and every one of those locations and check out the Woolworths store and go, I don't like that Woolworths, I don't like the neighbourhood that it's in, I'm not going to buy the shares? No, you would buy the shares because you're looking at it like a business, you're treating it like a business, you've removed your emotion, you've done your due diligence, and you focus purely on the numbers. As an investor, I don't care what the property is. I need to make sure I'm doing my due diligence, I need to be treating it like a business, and I need to make sure that numbers stack up. So firstly, you want to know where the value lies. You want to know, what is, what are other properties in the area selling for? Are the properties that you're looking at within the area comparable? There could be a good street, there could be a bad street. You could be comparing a good property with a bad property. They need to be apples to apples. Familiarising yourself with those areas, familiarising yourself with the markets, understanding what's happening in that market, what's causing for potential growth. If the market's crashed in the last 5 years, find out why the market has crashed. Find out, is there scope for that market to recover? Some markets I've seen out there that have bought in, which have crashed 90% of the value, where they used to sell for 500 grand, you pick them up for 50 grand. Some people might look at that and go, it's a bad investment. But when you pick it up for 50 grand and it goes to 200 grand in a year, you've bought in at the right time and you've got the value and you've got the upside that's gone with it. So you need to look at and research the market. You need to understand what are the drivers for the area of the market. You need to understand, all the dynamics as to why you're buying in that market. The second thing is making sure that the property is not a dud and you're not buying a piece of dog shit. So you want to make sure that you're, getting inspections done on the property, get a pest and building inspection. I think it's important. I've actually got this rule. where I never go in and see a property, even if it's just down the road from me, even if it's my principal place of residence, even if it's my holiday house. I never saw any of these properties before I bought them, even if I was in the neighbourhood in the area. Because when I go and see the property, I add my level of emotion to it. And I'll explain this in a second, but like you need to make sure that you've got pest and building inspectors that go out there and inspect the property and you look at it logically. So why I said emotionally and I never go and see a property is that I went and bought a property. It was my first motel that I ever bought. It's in the Blue Mountains. Paid $1.665 million for it. It's a block of 36 units. So there's about 40 grand per unit. And I remember at the time, I took a mate of mine out with me to show him the property, and we're there, and he goes, "Congratulations, Birchy, this is a great buy, blah, blah, blah." And even though the Blue Mountains is like 1.5 hours away from where I'm located, I never physically went there to go and see it. And the reason why I didn't go and see that property is because I was just A, a little bit lazy, B, when I bought it, I worked everything on a worst case scenario, and I was like, this property, if all hell freezes over, I'll still be safe because I bought it so far below market value. I've just bought it at land value, and I've got this big building that I've got for free. When I got out there, I looked at it and I said to my mate, "Wow, I would have paid $2.4 million for this thing." And then as I said that out of my mouth, I asked a question. I said, "Did you just hear what I said?" And he goes, "No, what did you say, Birch?" I said, "I would have paid $2.4 million. And he goes, "So what?" And he goes, "It's good property. Of course you'd pay that." And I said, "No, the important lesson today was that I would have paid 2.4, but I paid $1.665 million. And the reason why I paid $1.665 million is because I worked it on the worst case scenario. I took everything into consideration. When I got there, it was a bonus, and that was the upside that I saw. 2.4 million was still a good value and still a good buy, but I worked it on a worst case scenario. So my rule for myself is I actually don't even see my own properties that I buy, and I've carried that through my principal place of residence. My last principal place, which I currently live in, I paid $2.2 million for, and it's probably worth somewhere in the vicinity of $15 million at the moment. So, and that's only in 2 years period, just because I bought it, based on very raw fundamentals of where the value was at in the land. Getting emotional is always going to be the killer. Make sure that you're not buying things based on emotion. Make sure you're buying them based on logic. Make sure you've got the right team around you to protect you. Make sure you've got a good lawyer. And the reason why I say a good lawyer, I don't use conveyancers. Using a conveyancer can screw you up, especially if you're dealing with different laws and different states that you're not familiar with. So make sure you've got a good property lawyer that's going to be able to help you throughout that process. So, looking at having the right team around you, that can extend further to being, to your finance team, to property managers. Probably the biggest thing that I think people get fearful of is having a property manager or having a property interstate and not having a good property manager. So for me, I can't rely on real estate agents. There's a big difference. I'm an investor. I'm about wealth. I want money going into my bank account every week. I want to stop bleeding of money going out of my bank account. So for me, over the years dealing with real estate agents, it's been a really mixed bag. I can't control what a real estate agent office is giving me. So I've gone to the next step of building my own real estate offices where I have my own property managers that manage assets on behalf of myself and my investors to get the best results for those properties. So you're having a good property manager, but if you don't have a good property manager, find one. It may not be, you might find one agent that's crap. Go find another real estate office. There's normally 10 different agents in every sort of region, or 20 agents or 50 agents or 100 agents. So, if you go to Brisbane and you're in Melbourne, there's thousands of agents out in Brisbane. So if you're not happy with one, find one that's going to look after your best interest. And, you don't need to be there. What are you going to do? If you have a problem with the tenant, you're going to sit there and sit out the front of the property. You're going to go in there and knock the tenant out. Let's be serious about it. You need to have someone that's going to be able to look after your best interest. So it doesn't matter if that property was located in Sydney or Brisbane, in Melbourne, in Perth, wherever. You need good people around you. So, looking at the risks that could be there, you want to just be minimising it at every step along the way. If you're buying it below market value, great. If you're buying it with a strong cash flow, great. If you're buying it with upside for growth, great. Make sure the property's in good sound, good condition. Make sure that you've checked and done all your due diligence, and then what makes the difference between the property being in your area or out of your area. Ultimately, at the end of the day, the thing I realised when I missed out on those properties back in 2003. Those properties were worth about $50,000. They were renting for $100 a week. They're now worth about $250,000 to $300,000 each. Those properties, my fear was that it made I can't go to the properties and do the renovations to them. And, my fear at the time was buying townhouses, units and villas and all that sort of stuff. The reality is those properties have gone up. So my fear was stupid. It was just my opinion, my fear, my emotion. A fear is an emotion. And the other thing is that I'm not a tradie. So I now realise that my position is, as an investor, I want to go and, build wealth from buying assets, not try and be a tradie and try and change a tap washer, try and paint a place myself, etc. So, you need to know your position and work out, what's your overall strategy and what vehicle do you need on the day to get you to where you want to be. So, on that note, lots and lots of questions that could be asked in. I encourage you guys to put your comments below. If you need help with anything, you can always reach out to us at admin@B.Invested.com.au. Give us a call, 1300 367 925. I run a buyer's agency here where I locate and negotiate deals on behalf of my investors. I help my investors build their portfolios. I personally actually locate every deal for my investors, and that's what I've been able to do to build thousands of large property portfolios over the years. So if you do need help on building a property portfolio, do reach out to us. We're here to help. You'll be dealing with myself personally on your journey of buying and locating those properties. So, and as always, you can find us on Google, Apple, Spotify, YouTube. If you like what you're seeing, share it with your friends and family, smash up the likes and share the love. We'll catch up soon. Keep being awesome. Bye for now.
Like Bilal said, man, we're stuck in the matrix. This my advice, don't care if you take it. The dollar back to die, soon to be hyperinflated. This my 2 cents, don't care if you save it. Joint be decentralized and you will see you've been lied to the whole time, and it's the irony, cause they do the exact opposite. You become a slave to the system, enough your money, all they do is profit. There's no conspiracy theory, you better hear me. Crypto will set you free before the system does. I don't care if you do or you don't, but what I'm saying is the truth to the reason you choke. I've never been a failure, excuse my behavior. Keep talking, haters doing me a favor. They all tell lies, I know what they been telling you. I'm the opposite, the Donald Trump of Australia. It's amazing, here for the taking. My time is never wasted, just getting wasted. These girls say I'm really breathtaking. I can't help it.